Everyone that starts out trading gets stuck in a trap that I like to call the learning loop. The worst part about it is you don't even realize you are in it until it's too late. By the end of this video, you will know the path you need to follow to not fall into this trap and make consistent money trading. You'll understand how the market moves, what platforms to trade, and I'm going to teach you the strategy that I use every day that took me from being a struggling, unprofitable trader stuck in that trap to consistently profitable over the long term, trading larger size than I ever thought that I would. Now, the first thing you need to do is start to think like a casino. Trading is exactly like that. Every time you take a trade, you might win or lose, but the idea is over the long run, you are making money, just like a casino. If you go into a casino and bet $1,000 on roulette on black, you might win and you take $1,000 from the casino. But that's one time that happened. If you went and did that 1,000 times, the casino would always make money in the long run. And that's exactly how you want to approach trading. It's not about how much money you're making over one trade, two trades, or even 10 trades. It's about how much you're making over, let's say, 100 trades. Because just like the casinos, it takes time for that math to play out. And so you have to go into trading with that mindset of you're a casino and you have to wait for the probabilities to play out. This is a statistical game at the end of the day. Now, that doesn't mean go and take 100 trades in one day. What I found over the years is the best strategies are the simplest strategies. And the first thing that you see a lot of the time is when you're starting to learn trading is that there are a ton of videos telling you that they have an indicator that has a 90% win rate. And all you have to do is put this indicator on your charts and it will tell you when to buy and when to sell, and you'll make money. You'll just print it so easily. And trading is not like that. Those people are straight up lying to you, I would say. Nothing in trading will give you an exact outcome because otherwise everyone would do it, and that's just not how the market works. You have to find an edge in the market that works for you, and that takes time to figure out. It'd be nice if it was as simple as just putting an indicator on your chart, but that is not true. Now, the first thing you need to do is start to learn and understand charts. Now, the best way to do that is get a trading platform, and the best one that is accessible in most places is TradingView. Pretty much any country in the world can access it, and it has a ton of brokerages that you can link, and you can make an account and you can start trading on there with a demo account. And then you can also link and start trading real money. The one I use is actually called NinjaTrader. It's a little more specific to what I do. But if you're just starting out and just diving in, I would focus on TradingView. And you'll find the link to that in the description below. And then once you open it up, you will start to see charts. And this is the first thing that you need to do is you need to start to be able to read and understand what these are telling you. Now, the first thing is candlesticks. And so what these do is they represent the price movement over a certain amount of time. And so right now we're looking at a 5-minute chart. And so over this candlestick, it's telling you what the price of the market you're looking at did over those last 5 minutes. The candlesticks can range anywhere between seconds to days or weeks or months. And so you can look at a candlestick chart that tells you any amount of time in that candlestick. So you have to make sure you know what kind of time frame you're looking at. And then what these tell you is the green ones say, okay, the price opened up here and it closed here. And the high was where this little white line is. It's called a wick. And then the low is there. And so the price maybe did something like this where it opened, it trailed off a little bit lower, shot up higher, and then sold off a little bit and closed right there. And so it gives you a ton of information of what the market is doing. And for the red ones, it's just the opposite, where the market opens at the top of the box. The wick still means the high, and then the wick down here still means the low, and then it just says it closed at the bottom of the box. And so it's something like the market opened up here, went up a little bit higher, sold off, and then closed right here. And so this allows you to start to piece together, okay, what is the market doing? It's starting to go down, go up, go down, go up. And from that, you can start to piece together the movement. And so what moves these candlesticks? And all it is a difference between sellers and buyers. And so when the price of something is moving lower, it means there are more sellers than buyers. And so the sellers keep undercutting each other because they want to sell whatever they're selling. And so it pushes the price lower. And then whenever that shifts, and more buyers come in and they start buying it, it starts to level the price off. And then eventually, if there are more buyers than sellers, it'll push the price up because the buyers really want to buy whatever the market is. They'll start overbidding each other, saying that I will pay more than the last guy. And so it pushes the price higher over time. And so that's how these charts move. Is all it is it's the oscillation between buyers having control and sellers having control, where there are either more buyers pushing the price up or less buyers, and it moves the price lower because sellers are just trying to get rid of whatever they have. And so through this it starts to make structure in the market, and you can use this structure to create swings. And so with these swings, you can start to see what the market is doing, and you can start to understand the psychology and analyze the market trends. And so because of that, you can start to look at, okay, these swings are making highs and lows. And what those tell you is, in this case, it's making lower lows and lower highs. And so it's pushing the price lower over time, creating a downtrending effect in the price. And so you can start to see every time the market moves it gets weaker and weaker. And so sellers are stronger in this overall market. And then you can also have this on the flip side, where you can just have an uptrend. Buyers are getting stronger and stronger over time, and sellers are getting weaker and weaker. And you can use this information to analyze the market, and you can start to create trends where we have a downwards trend line and even a downwards channel that the market is in. And so you can use this to predict that, okay, in the future, when the market moves down in this trend, that when it comes up to this downwards trend line or upper end of the channel, that it's more likely to sell off. And then when it gets to the lower end of the channel, it's more likely to find some support and trend back to the other side of the channel. And so that's how you have trends in the market. Now, another thing though, if we zoom out here, is sometimes the market will continuously bounce in the same area. And so what this can do is it creates a supply and demand zone. And so every time the market comes down into the supply zone where buyers are strong, is that they're more likely to buy up the market, pushing it higher. And so this is how you can create support and resistance levels in the market and take trades between them and make money trading. Now, the 4 key steps to having a consistent strategy is looking for a structural pattern in the market that you can consistently identify. And then when you see that pattern show up, have strict entry rules that you follow every time you jump into a trade. So when you jump into a trade, you can repeat it consistently like a casino. And then when you jump into a trade, have consistent entry and exit rules so you know what to do when the market either plays in your favor or goes against you. And the final step is having that consistent risk reward structure where you're risking, let's say, $100 and going for $200, $300, or $400, because this is a positive risk reward ratio, which essentially means every time you win, you make a lot of money, and every time you lose, it's not that big of a deal. And to look at risk reward combined with win rate is if you have something like a 1-to-3 risk reward ratio where you're risking $100 to make $300, you only need to be right 30% of the time to be consistently profitable. And so if you're right even 50% of the time, you are consistently making really good money trading. And so that's where you want to have a very favorable risk reward ratio, because if you go something like 1-to-1 risk reward ratio where you make where you risk $100 to make $100, you have to have a 60% win rate to consistently make money. This is where it comes down to when you hear people say, oh, I've got a 90% win rate strategy, you have to know what their risk reward ratio is with that strategy, because some people can have a really good win rate, but their risk reward ratio is something like 1 to 0.25. So every win, they make $100, but every lose, they lose $400. And so this is a negative risk reward ratio, and this will ruin your trading over the long run. And I've done this, and it's insanely hard to be consistently profitable doing it. Even if you have a high win rate, every time you lose, it just feels like a punch in the gut. You lose a ton of money compared to your wins, and every win, it feels like you barely made a dent in your losses. And so if you take away anything from this video, go with a profitable risk reward ratio. The best area, I think, is going for a 1 to 2, 1 to 3, because it makes it so you do not have to be right very often, and you can consistently make money in the long run, because that's all we're trying to do. It's all about that long term. And so I know this is a lot to unpack, and so let me walk you through my strategy that I use every day to trade consistently like a casino. Hopefully this will help bring a lot of this stuff together, and I'll point out a couple of beginner mistakes that are really crucial to pay attention to. And so when it comes to me and my trading, all I do is I go with what I've been talking about. Is I just look at the candlesticks showing you that supply and demand and pointing out that structure of what the market is doing. And so think of this like you're watching the market in real time. You're seeing the candlesticks move. Clearly the buyers are in control right now. The market is moving higher. And if you look at it here, well, beforehand is the market had a sell-off up in this level up here. And so because of that, you can see the market moved all the way up here into this level in a nice uptrend where buyers were in control, and then it moved down, and then it moved back up. And so what I do with that information is I think, okay, clearly sellers came into play here. And so I want to think of this like a supply and demand zone. I've got a video that goes way more in detail of how I draw these levels. I'll kind of link it up here in the card. But the basic idea is just seeing, where has the market come up to this level and sold off of? Just predicting that, okay, where it's done in the past, it's more likely to do it in the future. And so because of that, I want to think about, okay, if the market comes up to this level again, I think we might start to see a shift in buyers starting to dry up and not push the price, and it start to level off. Once things start to go into a sideways movement, that actually means there's equilibrium between buyers and sellers. There's an equal match between buyers and sellers. And so it's not pushing the price up or down. And so when you see that right after there being a strong amount of buyers, it shows you that it's starting to lose that upwards momentum. And that is the first stepping stone to it actually shifting and sellers take control. All you're trying to do when you're trading is start to predict what the market's going to do, and you have to piece together clues that it's giving you. And so it coming up into the area before, that's the first clue, is we're at an area where the market has shifted that momentum, and then we want to analyze the trend coming into that level. And so right now it's still just consistently moving in an uptrend. If you kind of look at this movement here, it's just consistently going higher. And so one thing is I like to draw trend lines to make it a lot easier to see. And so looking at this trend line right here, what it does is it helps match this trend line. And so a lot of the times that I found over time is when a trend breaks, it's another piece of the puzzle that the market is potentially going to shift, because the market likes to ebb and flow. And if it's kind of in one kind of ebb, it's going to consistently keep doing that. And then once it shifts and you start to see a shift in what it's doing, it usually is meaning that, okay, it's going to start changing what it's doing. And so seeing that it's broken this uptrend at the area where we're thinking sellers might start to take control, that's another good clue that the market is starting to potentially shift. And you can see here as well as these candlesticks, we're starting to see more red candlesticks where the market is starting to sell. If you look at this uptrend right here, it's mostly green. There's a couple small red candlesticks, meaning the price moved a little bit down, but there was nothing compared to these bigger ones right here. And so that's showing you more of a shift. And so that is a really nice signal that the market is starting to lose that momentum. And so the last kind of structural thing I like to see is when we were looking at this is the market, in an uptrend, it makes consistent higher highs and higher lows. Well, if it's going to start switching, it's to a downtrend starts making lower lows and lower highs. And so what that means is there's just a structural shift. Is as the market is moving forwards, every time the market makes a new high, that means buyers are still getting stronger because it took out the previous high. But if all of a sudden the market can't do that, buyers are now weaker and sellers are getting stronger. And so this right here is starting to do that. Is it makes a high here, it's still making higher highs, but all of a sudden the market comes up here and sells off. And so this is a lower high, meaning that buyers are getting weaker and sellers are starting to get stronger. And you can see there's a nice big bearish bar. And so this is where just reading into the candlesticks of showing what the price is doing over time really starts to tell you. That's where I like to enter in on a trade and get short, betting that the market is going to go lower. And so this strategy is actually something that works for betting the market's going to go lower and making money, and also betting that the market is going to go higher and making money. And so that's something that not a lot of people realize when they first start out. You can do it in both directions. And so what we're looking at here is this is me in a trade. I have entered in on the trade right here, betting the market's going to go lower from this point. And then right up here, this is my buy stop. And so that just means if the market comes up here, I'm going to get out of the trade at a loss. And so in this trade, I'm risking about $300. And then my target, you can see, is down here. And so that target is based off of my structural read of the market. Is I think that we have a zone up here that is more likely for the sellers to come in, buyers to dry up, and the market price will move lower. And then once it comes back down to this zone where the market found support and buyers came into play pushing the price up, that's a more likely area for it to bottom. And so all I'm looking for here is the market to basically just push lower into that area, and I'll get out of the trade. And getting out there is going to be something like a 3 or 4 times risk reward ratio. So if I bet $300, I'll make close to $900 or $1,200 on this trade. This doesn't have to work every time for me to consistently make money. I can take this bet and lose 2 to 3 times, and then if I win on the 4th, I will still make money in the long run. And so that's kind of the beauty of this, is it allows you to take these chances, because every time you enter into a trade, it's going to be nerve-wracking. You're kind of jumping in to the unknown. You know, even though you have these kind of clues based on reading the market, you don't necessarily know that that's how it's going to play out. The market will do whatever it wants most of the time. And so that's just something you have to realize and just accept that it's always going to be kind of that unknown. Just like a casino, they don't know that they're going to win on any individual bet, but over time, their bets win consistently and make them money. Now, one of the biggest mistakes I see beginners do is not having a plan when they jump into a trade. They have all the idea of, okay, what am I looking for? You know, this is my 5-step checklist of plan I want to look out for when I jump into a trade, but they don't know what they're doing when the trade either starts to go against them or in their favor. And you have to have that planned out as well. And so the first thing there is making sure you have your stop loss in an area that makes sense and you do not move it farther away. And so what I mean by that is when I entered in here, my stop loss, I put it up here because my thought was, you know, I'm going with those swings, right? I think the market made a swing. And if the market comes up here and breaks the high of that swing, well, think about it, you know, it's breaking the structure of the market. And I think buyers are getting stronger at that point. And, you know, I think the overall idea of the market pushing lower here is less likely. And so I just want to cut my losses and move on to the next casino bet. And what I do see some beginners do, and some beginners make this mistake, is they have their stop loss here. The market starts to go against them, trending up. They get nervous and they move their stop loss farther away, which increases their risk on the trade, decreasing their risk reward ratio and making their math in the long term worse. Generally, I've found the best trades work really fast in your favor, and the ones that just aren't gonna work, they just knock you out pretty quickly, and you do not need to give them more room. Sometimes the market will knock you out, but most of the time you're kind of chasing a hope and a dream at that point, and you're just gonna lose more money doing that. It's better to double down on your winners and cut your losses quickly. And so as this market moves down in my favor, you also have to have an exit strategy. And so for me, what I'm doing is I'm moving my stop loss as the market goes in my favor, because in this particular trade, the market's going down in my favor really fast. And so I actually have been moving my profit target farther away because I'm letting the market kind of do what it wants to do. You can see here, it's moving very quickly. And so if it moves very quickly in my favor, I want to capture that profit and not get out just yet. You know, you don't know what the market's going to do, right? And so you want to let it kind of run in your favor sometimes. But I'm moving my stop loss down, so if it comes back, I'm still able to capture that profit. I don't have my stop loss all the way up here, you know, risking that I'm up $1,400 on this trade right now. I'm only risking a couple $100 if it comes back here, you know, versus all the way back here, I'd be risking, you know, giving back all that money, which just is not the way to trade. And so there's a lot going on here. And so what I'm actually doing is I'm trading futures here, which allowed me to start with a really small account. You can start day trading and scalping with about $500 or less in your account and grow it from there and start risking, you know, $20 per trade. And so if you're really small, you can start out that way, and it allows you to also day trade, which you can't actually do with a lot of other assets like stocks. And so check this video out right here. It's gonna go into every detail of how futures work, how you can get started with them, because that is the best way that I would suggest to start day trading.